When we talk about UK exposure, we're usually referring to the FTSE 100, the largest 100 companies by market cap on the London Stock Exchange. The FTSE 250, on the other hand, barely gets a mention. This is a mid-cap index covering 250 companies, ranking between 101 and 350 by market cap. There is sometimes confusion that the FTSE 250 simply covers the largest 250 companies, but it does in fact cover the next 250 companies after the FTSE 100. The FTSE 250 has actually outperformed the FTSE 100 quite considerably over a long period, going back to the mid-2000s. Since 2004, it's 514% versus 394%. But one reason it doesn't get a lot of attention may point to its lack of performance in the past 5 years relative to the FTSE 100, 79% versus 24%, and a large chunk of that has come in the last 6 months. 14% versus 6%. There's a few reasons for this performance difference, one of those being themes. Two big drivers for the FTSE 100 in the past few years have been miners and defence stocks. Miners have performed well because commodities like copper and precious metals have gone up in price. And defence has also been a massive driver from increases in defence budgets due to geopolitics and global conflicts. Forex has also played a massive part, with the pound falling in value against the euro. At the start of 2025, the GBP euro exchange rate was sitting around 1.2. Today it's sitting around 1.14. This is where the FTSE 100 tends to benefit because a lot of its revenues come from overseas, where the FTSE 250 is slightly more domestically focused. That closer tie to the UK economy has also been a headwind due to the fiscal backdrop, a lack of economic growth combined with stubborn inflation, a cooling labour market and tax rises. And then finally, there's also been some diversification away from expensive US tech, with the popular FTSE 100 being felt as undervalued, especially with some well-known consistent dividend payers. But what are some potential tailwinds for the FTSE 250 in 2026? It's quite a diversified index, especially at stock level, with the top 10 making up about 12% of the total, especially compared to the FTSE 100, albeit with less companies, but its top 10 makes up around 46%. And even compared to the S&P 500 with twice as many companies, its top 10 making up around 40%. Only thing to note, however, could be its slightly heavy weighting towards financials, around 28%. Rallies in stock markets tend to move in waves, where a particular theme or sector will increase in value until it gets to a point where investors might feel that it's overvalued. And at that point, it might start to look at other themes or other regions or countries. We've seen that more recently with the US tech stocks. People have felt like there's an AI bubble coming. They've seen rapid growth over the past 5 years, but now people feel like they are slightly overvalued, so they're starting to look elsewhere. And that's one of the reasons for the FTSE 100 growing so much in the past year. And at some point, the FTSE 100 will be deemed overvalued if it continues to increase like it has done. And then at that point, is it time to then look at the FTSE 250? At the end of 2025, the FTSE 250 had a price-to-earnings ratio of 12.8, much lower than the FTSE 100, which had a price-to-earnings ratio of 18, and especially lower when compared to both a global ETF, which had a price-to-earnings ratio of 22.8, and the S&P 500, which has a price-to-earnings ratio of a massive 28.3. You can't, however, just look at price-to-earnings ratios on their own. The S&P 500 is deemed expensive, and the FTSE 250 may be deemed cheap. But that's for a reason. That's how investors have valued the indexes. But what a low price to earnings ratio does give you is more scope. If the other tailwinds do materialize, then you've got more runway. You're in theory buying more value stocks. You should expect a little bit more volatility, especially compared to the FTSE 100. But with volatility also comes opportunity. The UK economy is also going to play a massive part. And this could be perceived as a potential headwind, but it depends how you look at it. There was a lot of negative data and sentiment last year, from inflation to the labour market, economic growth, tax rises. But when you're looking at the value and the price of an investment, that data is already baked in. What you're mainly looking at is what direction investors feel that data is going to move in the next few years. And while interest rates may not have moved down as quickly as we would have liked, we've still got some of the highest interest rates in the G7. We did have 4 rate cuts last year, and it's expected we might have 2 or 3 more into 2026. We've also seen inflation come down from its peak a few years ago. It has somewhat stabilised, and it also has become quite sticky. But we've also got to remember, in the first 2 budgets since Labour came to power, we've also seen massive tax rises, especially with the national insurance rise. That's very pro-inflation. At the same time as things like business rates going up, businesses are having to pass that cost on to the consumer. But if we see these companies able to ride through that period and the UK economy somewhat stabilises, then that could be a tailwind for these mid-cap stocks. Dividend yields are also still strong, with a current dividend yield of 3.48%. That compares to the FTSE 100 sitting at 2.95%. What's interesting is when we compare this dividend yield to the past few years. With the FTSE 250, it appears as though the yield is somewhat stabilised and maintained. Where the FTSE 100, it feels like it's reducing. But that doesn't necessarily mean the FTSE 100 is paying lower dividends. It just means because it's had so much capital growth, it's got an effective lower dividend yield. But if you are investing into this index for its income, then the FTSE 250 could be a good option, especially as historically the FTSE 250 dividend yield has actually trailed the FTSE 100. It's only more recently that it started to overtake it. And finally, mid-caps are also a frequent target for mergers and acquisitions. It's not just investors who are looking for potential undervalued companies, it's also large corporations. And when a company gets acquired, that can cause massive rises in its share price. Now let's have a look at some of the reasons against the FTSE 250 for this year. This isn't specific to now, but these are market cap weighted indexes, and they generally get reviewed on a quarterly basis. That means in the FTSE 250, if a company does really well, it might get promoted to the FTSE 100, and in the FTSE 100, a company might get relegated. And that means a well-performing company can actually leave the index. We mentioned the UK economy stabilising as a potential tailwind, but we have to mention the government here. At a fiscal level, the current government haven't exactly been business-friendly, should we say. A lot of pro-inflation measures, and that shows up in the latest data. We've just had inflation data for the year to December at 3.4%. That's up from 3.2% the month before. The consensus sat around 3.3%. But more worryingly, core inflation, which strips out the volatile items such as food and energy, remains at 3.2%. That's the really sticky inflation that can be really hard to get down. And that's mainly what interest rates are targeting. But we've predominantly seen interest rates come down. 4 rate cuts last year, with 2 to 3 more predicted this year. And that's not all because inflation has been coming down. The Bank of England are also massively worried about the labour market. Because the government has increased taxes on businesses so much, especially the national insurance increase, that means businesses can't afford to employ as many people, and that's affected the unemployment rate. The Bank of England is really stuck between a rock and a hard place. They'll want to cut rates to aid the cooling labour market and to help economic growth. But doing so while inflation is elevated is such a tricky balance. I think if we get the expected 2 to 3 rate cuts this year and the rate moves closer to 3%, then that will be positive for the stock market. But the whole picture can change so quickly. But if you do decide the FTSE 250 is worth exploring for your portfolio, then one of the best options out there is the Vanguard FTSE 250 ETF. It has the ticker VMIG and has an ongoing charge of 0.1%. In the comparisons when we were looking at performance differences, I was using the iShares FTSE 250 ETF. But that was simply just because the data goes back further. This ETF has an ongoing charge of 0.4%, and it also only comes in a distributing share class. That isn't necessarily the end of the world because you can just reinvest the income, but paying 4 times the ongoing charge for the same ETF, you may as well just go with the Vanguard fund. But before you invest into the FTSE 250, ask yourself these 3 questions. Do you specifically want UK domestic exposure, or do you just want UK stocks and a strong dividend tilt? That will help you decide if you simply just want the FTSE 100, or if you actually want the benefits coming from the FTSE 250. Ask yourself, can you hold through high volatile periods? It's likely the FTSE 250 will be more volatile than similar indexes. So have you got the time horizon in order to ride that out? It could pay off in the long run, but you've got to be prepared for some large drawdowns along the way. What have you got already as your core holdings? If you already own the FTSE 100, then you could potentially own the FTSE 250 as well. You haven't got to worry about overlap because those companies will get promoted or relegated. They can't be in both. But you have got UK exposure in general to think about. If you've got a global ETF and then you also hold a FTSE 100, there will be some slight overlap there because the UK makes up about 3% of a global index. But the FTSE 250, because they're smaller companies, although some of them might be included in a global ETF, there's much less overlap, especially because it's market cap weighted. It's definitely an index that doesn't get spoken about that much. So I'll be really interested to hear your thoughts down below in the comments. Thanks for watching.